Welcome to Breaking News to Trading Moves. Today we're looking at a pretty important piece of corporate news. It's the updated financial guidance from CVS Health. That's ticker CVS.
Right. And this guidance, it's not just for the next quarter. They're giving projections a few years out, which, that gives you a real window into their long-term thinking.
Exactly. It's more than just a simple earnings adjustment. It really feels like a statement about the strength of their whole integrated healthcare model.
Mm-hmm.
So our goal today is pretty straightforward. We'll look at the specifics of this financial roadmap from CVS, and then from there we'll try to identify which kinds of companies the market saw as, the winners and losers from this news. We're basically tracking where the money and the confidence went after a giant like CVS pointed in a certain direction.
And the main story that seems to be coming out of this is one of, well, a kind of quiet confidence. CVS Health, ticker CVS, gave investors another dose of certainty by raising its profit guidance for 2025. But you're right, the real focus was on that longer-term look.
So what did they actually say for 2026? And how did it stack up against what analysts were expecting?
Okay, so for 2026, the company projected adjusted earnings per share, which is really the metric Wall Street watches for operational health. They said it would land somewhere in the range of $7 to $7.20 per share.
And that was higher than the consensus.
Just slightly. But, crucially, this forecast is 3 years away. So for them to nudge it even slightly above what Wall Street was expecting, well, in the healthcare sector, with all its volatility, beating forward expectations by any amount is a pretty positive signal. It suggests management feels they have a clear path forward, even with cost pressures on the horizon.
Yeah, you'd have to have a lot of operational certainty to put a hard number like that out there, especially 3 years out. I mean, this is a business that's always under regulatory pressure, and medical cost inflation is a constant. So where's this optimism coming from? What parts of their huge diversified business are really driving this?
The answer is really all about their integrated model and how well it's working. This improved outlook isn't coming from everywhere equally across the company. It's really being driven by stronger margins that they expect in two of their main segments.
Let me guess. Aetna and Caremark.
You got it. The Aetna insurance arm and the Caremark pharmacy benefit management business, the PBM. Those are the two engines.
That synergy between Aetna and Caremark, that's really the core of their whole strategy, isn't it? The idea that you can control the demand side with the insurance members and the supply side with the drug costs, that has to be where the margin expansion comes from.
That's precisely it. The integration between Aetna, which is managing the medical risk, and Caremark, which is negotiating drug prices, that's creating a kind of financial optimization that a standalone company just can't match. I mean, think about it. If you own the insurer and you own the PBM, you can steer patients and manage treatments in a way that just maximizes your own internal profitability. It gives them so much more control to negotiate with drug makers, with pharmacies, and to fight back against some of the utilization trends that have been a problem for some of their competitors.
When you say utilization trends, you just mean people using more healthcare services.
Exactly. More doctor visits, more procedures, and that's been a headwind for the industry.
That makes a lot of sense. Controlling care costs and drug costs under one roof just allows for a whole different level of management. But beyond the margins, this company is just staggering in its scale. What about the top line? What are the revenue expectations that go along with this earnings forecast?
Well, they're aiming for true dominance on the revenue side, too. They expect to hit at least $400 billion in total revenue in 2026.
$400 billion.
Yeah. And to put that number in perspective, getting there isn't just about making Aetna and Caremark profitable. It means they have to leverage every single asset they have. It requires an incredible amount of cross-selling, pushing insurance members to their PBM, to their retail stores, and to their growing network of minute clinics and health hubs.
So that $400 billion target is really built on the assumption that their scale will just keep outpacing everyone else.
That's the bet.
Okay, so a revenue target like that, alongside growing margins, tells me there has to be some serious financial discipline going on inside the company. What kind of internal strategic moves are they making to make sure those margins hold up?
The guidance was pretty clear on that. They're actively managing their portfolio of businesses, which is a move away from the old sort of growth at any cost strategy. They laid out two main actions. First, they're just committed to tightening costs everywhere. That means things like operational streamlining, using more tech and automation, maybe AI, to cut down on administrative costs, and constantly reviewing all their supplier contracts. They're looking for efficiencies all over the place.
And the second action, that one seems like it has bigger implications for the industry.
It does. The second part is that they're planning to systematically exit weaker lines of business. So anything that either requires too much capital or just doesn't offer enough profit potential compared to their main integrated businesses.
So they're pruning the tree, basically.
That's a great way to put it. They're focusing their resources where their scale gives them the biggest advantage. And we actually have a concrete example of one of these exits, which tells us a lot about where the healthcare market is most challenging right now.
And which exit is that?
CVS confirmed it's going to pull out of the Obamacare exchange plans in 2026.
Wow. Okay, so this isn't just a small adjustment. This is a full strategic departure from the individual marketplace created by the Affordable Care Act.
It's a full departure.
When a company the size of CVS makes a move like that, it sends a very clear signal. What is this telling us about the ACA marketplace for these big insurers?
It really highlights how difficult it is to stay profitable in that specific market. I mean, the ACA marketplace serves a really vital function, but the customer pool often has higher medical needs, meaning they use more services.
Right.
And at the same time, there are strict rules on how high you can set premiums and what benefits you have to cover. So when medical costs are going up across the board like they are now, those two factors just squeeze the margins for insurers in that space.
So what you're saying is, even with all of CVS's scale and its vertical integration advantages, it just wasn't enough to make the ACA marketplace as attractive as, say, their Medicare Advantage plans or their big employer plans.
That's it, exactly. They're putting their capital where their controls, that Aetna and Caremark combination, give them a better advantage and a higher return. They're essentially saying that fighting rising utilization and strict pricing rules in the ACA pool is just not as good a use of their resources as expanding their core businesses. And that's a powerful signal about where capital is flowing in the managed care industry.
Okay, that gives us some great context. So let's look at how the rest of the market reacted to all this. When CVS, ticker CVS, puts out strong guidance and a clear plan for the future, it creates an immediate reaction. And the first category of clear winners seems to be the other huge integrated healthcare giants.
Yeah, that read across is immediate. It makes a lot of sense. The basic idea the market is validating is that CVS's strong performance just proves the business model works. Combining insurance, PBM services, and care delivery. This vertical structure is now seen as, well, not just a way to grow, but as a defense against all the cost volatility in the industry.
So the message becomes that diversification, where your insurance risk is offset by PBM, cost control, and retail care. That's the blueprint for success right now.
And that success, of course, starts with CVS Health itself, ticker CVS. The guidance just confirmed their strategy is working, that they're meeting or even beating expectations. I mean, they showed they can buy these massive companies, integrate them, and then pull profitable long-term growth out of them. It's really a testament to their execution.
But the market's attention immediately goes to their closest competitor, right? The other company that runs a very similar diversified model. We have to be talking about United Health Group, ticker UNH.
UNH is definitely the prime beneficiary here. Outside of CVS itself, they run an almost identical model centered on that deep vertical integration through their massive Optum services arm.
And Optum has its own huge PBM, care delivery clinics, tech services, all sitting next to their giant insurance business.
Right. So the logic is, if CVS can successfully manage medical inflation because of its Aetna and Caremark structure, the market just applies that same thinking to UNH's ability to handle costs using its Optum engine.
So the market sees that size and that tight vertical control are what matters for profitability in healthcare right now.
That's it. When CVS confirms its model is leading to outperformance, it just raises the bar for what people expect from UNH. It reassures investors that UNH's strategy is also robust and sustainable, especially when fighting those industry-wide cost spikes.
The assumption is if one giant is getting costs under control, the other one probably is too.
Probably is, yeah.
Okay, so let's move on from the fully integrated giants. That's a pretty exclusive club. What about our second category of winners? The larger managed care peers. Even for big insurers that maybe don't have a giant PBM like Caremark or Optum, this news still seemed to be a positive.
It was, and this is really based on the strong guidance around Aetna's margin recovery. Seeing that margin control within a major insurance company acts as a powerful signal for the other large health insurers. It suggests that the industry as a whole is getting a better handle on the medical cost trend that really accelerated after the pandemic.
Why is Aetna's performance so important for the rest of the sector? Does it suggest that they've all figured out how to manage utilization better?
It absolutely suggests that. Aetna's results imply that these big insurers, using their scale and all their data, have put better pricing strategies and utilization controls in place.
You mean things like more prior authorizations?
Right, more rigorous prior authorizations,
Yeah.
optimizing their provider networks, guiding patients to more cost-effective places for care. This ability to handle both higher utilization and general medical inflation lifts the prospects for their main peers.
And who are the direct beneficiaries here in this uh, non-fully integrated but still very large managed care space?
Two companies really stand out. First is Elevance Health, ticker ELV. Elevance benefits right away from this positive sentiment about scale. The belief is that if CVS is getting Aetna's costs under control, Elevance is probably doing a similar thing across its own large member base.
Okay, that makes sense. And the second one is the Cigna Group, ticker CI. Their connection to this is a little different, though, isn't it?
It is a little different, but still beneficial. Cigna is viewed favorably not just because of its core insurance business, but because it operates Express Scripts, which is one of the other giant PBMs.
Ah, right.
So while Cigna isn't as deeply integrated into retail care as CVS is, the fact that CVS highlighted the strength of its Caremark PBM unit confirms that the PBM business model itself is still highly profitable. So Cigna benefits from two things: the positive sentiment around medical cost control in general, and the specific profitability that was just confirmed in the PBM sector.
Let's switch gears to our third group of winners, which gets into the supply chain itself. If CVS is showing strength in its Caremark PBM and its pharmacy operations, that positive feeling has to flow downstream
Right.
to the entire drug distribution ecosystem.
It does, and that ecosystem is really dominated by just a few massive distributors. So if a giant PBM like Caremark signals that it's stable and growing, that is inherently good news for the distributors who physically handle all the product moving through that system.
So the thinking is, a strong PBM for CVS means the flow of drugs through the system is robust and predictable for the people handling the logistics.
Mm.
Why is that PBM stability so key for the distributors?
It's because distributors operate on incredibly thin margins. They rely completely on volume and predictability. Their profit comes from processing huge quantities of products very efficiently, and the PBMs are the ones who control that volume.
Through their mail-order pharmacies and their network contracts.
Exactly. So if the PBM is healthy and processing a huge, stable flow of drugs, it means the distributor's core business of warehousing and delivery is secure and growing.
Okay, so which specific companies get a boost from this?
Well, the major drug distributors are the immediate beneficiaries. Cardinal Health, ticker CAH, is a perfect example. Their entire business model depends on the volume and efficiency of these PBM systems. If Caremark, one of the three biggest PBMs, confirms its long-term stability, it reassures investors that CAH's core distribution business is safe.
And I assume the same logic applies to McKesson, ticker MCK. They're the other huge player in that space.
Absolutely. McKesson, MCK, is supported by that same positive sentiment around the PBM and drug distribution supply chain. You know, when a major organizer of drug flow like CVS signals high confidence in the profitability of getting drugs from the manufacturer to the patient, the companies that are the logistical backbone of that process see their prospects improve immediately.
It's like a chain reaction. Strong planning from the PBM means reliable demand for the distributors.
That's it.
It's pretty clear that the market's verdict on the winners is a huge vote of confidence for size, integration, and control. The market is rewarding the companies that can manage their own internal risk.
That's the main takeaway. They're seen as the safest place to be in a volatile market because their structure lets them absorb costs that would just crush a smaller, more specialized company.
So now we have to look at the other side of the coin. The categories the market decided would be on the losing end of this guidance. And our first group seems to be the ACA marketplace-focused insurers. The big signal here is CVS pulling out of the Obamacare exchanges in 2026.
Yeah, that strategic retreat is a really powerful piece of evidence for investors. The main reason these companies suffered is that the CVS exit just reinforces this idea that the individual market plans are extremely difficult to operate profitably, especially when medical costs are high.
Right. The market sees CVS moving its capital to places with higher returns, which implies that the ACA marketplace just doesn't meet their threshold. And that's got to be a problem for insurers who are much more heavily exposed to that market, who don't have a giant PBM or a big Medicare business to fall back on.
The most direct loser, in the market's view, was Oscar Health, ticker OSCR. Oscar is just intensely exposed to that individual market segment that CVS is now leaving. Unlike CVS, Oscar doesn't have those big diversified revenue streams.
So when a giant like CVS says the ACA market is too tough, the market looks at Oscar and thinks their climb to profitability just got even steeper.
That's exactly it. Oscar's whole model relies on being technologically efficient in a segment that CVS, with every tool at its disposal, is finding too punishing from a financial perspective. It just creates a lot of uncertainty about Oscar's future.
And this negative feeling also hits other large companies that have a big presence in that space, like Centene, ticker CNC.
Centene, CNC, has a massive presence in the ACA marketplace, along with its Medicaid business. And while Centene is more diversified than Oscar, the news from CVS really highlights the structural difficulty of making money in the individual market. If a behemoth like CVS can't make it work profitably, it raises real questions about Centene's ability to generate reliable earnings from that segment, especially if utilization stays high.
Okay, let's move to our second category of companies that took a hit. The traditional retail pharmacy chains. This is where the structural differences between CVS and its rivals really stand out. CVS is pretty openly relying on its high-margin insurance and PBM segments to drive its growth.
And that creates a direct problem for companies that don't have that same structure. If you don't have that PBM and insurance buffer, you're disproportionately exposed to the parts of the traditional pharmacy business that CVS is trying to, frankly, subsidize with its more profitable segments.
So these pure-play retail pharmacies, they're just more vulnerable to pressures on dispensing margins and weakness in front-of-store sales.
The textbook example here is Walgreens Boots Alliance, ticker WBA. Walgreens just has less diversification than CVS. And while Walgreens is making some aggressive moves into healthcare services, like their partnership with VillageMD, their overall financial structure is still heavily exposed to those traditional retail problems.
So the CVS news just reinforces the idea that retail pharmacy by itself isn't a strong enough engine for growth in today's market.
Right. WBA's transformation just isn't happening fast enough to compete with the established buffer that CVS already has from its PBM and insurance businesses.
And can we apply this same logic to other retailers that have big pharmacy operations, even if they aren't dedicated pharmacies?
You can. And that brings us to a company like Kroger, ticker KR. Even though Kroger is mainly a giant grocery retailer, the market views its pharmacy operations through that same lens of traditional retail challenges. They don't have an integrated insurance or PBM buffer to protect them from volatile drug costs or changing reimbursement rates. The grocery store pharmacy model is seen as being subject to the same margin pressures that CVS is actively avoiding through its other, much more profitable businesses.
So the market basically sees these non-diversified pharmacy operations as being at a structural disadvantage.
Yes, compared to the vertically integrated giants they are.
All right, let's talk about our final category of companies whose outlook seemed to dim after this news. The standalone digital health and navigation platforms. This gets into the competition for who controls the consumer's front door to healthcare.
This is a really crucial area of competition. And the reason for the negative reaction is that CVS is very aggressively building its own unified, integrated patient engagement platform. They're using technology, including AI, to tie together their insurance, their pharmacy services, and their care delivery into one seamless internal experience for their members.
That seems like the logical next step for their model.
Yeah.
I mean, if you own the insurer, the PBM, and the clinics, you have to own the digital interface that connects them all.
And when you do that, when you build that internal platform, it makes it incredibly difficult for separate third-party digital health apps to establish themselves as the main front door for patients in that CVS ecosystem. The question becomes, why would CVS pay a third party for patient navigation or virtual care when they can just drive that traffic to their own internal services?
This internal development really poses a competitive challenge for companies that rely on contracts with insurers to get patients. Let's talk about Teladoc Health, ticker TDOC.
Teladoc faces immediate competitive pressure from this push by CVS to deploy its own integrated tool. For example, if Aetna members are encouraged, or maybe even required by their plan, to use CVS-developed virtual care, Teladoc's ability to gain or keep market share within that huge population is severely limited.
The integrated player becomes its own in-house vendor, essentially.
Exactly. Displacing the external providers.
And does that same dynamic apply to more specialized digital health companies like Hims & Hers Health, ticker HIMS?
It does. Hims & Hers Health focuses on virtual primary care and wellness. As CVS tries to consolidate that entire patient journey, from finding a doctor to booking a virtual visit to managing prescriptions through Caremark all within its own digital walls, it just limits the need for standalone platforms that only provide a piece of that service. The market sees this as the integrated players building digital moats around their patient populations, strategically limiting access for outsiders, and just shrinking the potential market for these specialist apps.
The goal is to keep the patient and all the profit that comes with them entirely in-house.
That's the model.
We've certainly covered a lot of ground that stemmed from this one piece of corporate news. If we take a step back and try to synthesize the whole market reaction, what's the one big lesson from this CVS update?
I think the core lesson is pretty clear. Market favorability is flowing aggressively toward these integrated healthcare models. These are the companies, like CVS, that can use their massive scale and diversification, especially that strength from combining insurance and PBM operations, to absorb costs and market pressures.
And this optimism for the giants comes directly at the expense of their more specialized or non-diversified peers. Companies focused only on the ACA marketplace or traditional retail pharmacies or standalone digital health apps.
It's a decisive signal from the market that controlling the entire vertical supply chain from risk all the way down to drug dispensing is the most rewarded investment strategy in healthcare today. It's about reliability and control over specialization.
That brings us to a final thought for you, our listener, to consider. We've seen the market reward massive scale and integrated services because they promise financial predictability. But that focus on profitability can come with trade-offs for consumers, which is perfectly shown by CVS choosing to exit the Obamacare exchanges.
And that raises a really critical long-term question for the whole healthcare system. What are the consequences for consumer choice and accessibility when profitability means major players just exit high-need market segments like the ACA marketplace? Does this relentless push for scale and integration penalize specialization, even when that specialization might offer a consumer a better digital tool or a more responsive local insurance plan? It's a complex balance the entire system has to navigate as these giants continue to optimize their businesses based on margin.
That is certainly a vital question to keep in mind as we watch the sector evolve. Before we wrap up, we must state the following clearly. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author. Thank you for joining us for Breaking News to Trading Moves.